Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Oracle.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis. For years, right, the market just saw Oracle as this legacy software company.
Reliable, but kind of slow-moving, not exactly exciting.
Exactly. But that whole narrative is, it's just fundamentally changing now. They're undergoing this profound transformation.
Moving into that cloud powerhouse territory.
Right. And the data is finally reflecting that shift. And, aggressively.
That's the real tension here, isn't it? Can a behemoth, a company built on these old proprietary databases, actually pivot fast enough to compete with Amazon and Microsoft?
That's the billion-dollar question.
So let's start with the financials. We're seeing some surprising acceleration, especially in that cloud segment, right?
It's the key signal. It really is.
For a company of this size, to see growth accelerate instead of slowing down, that's a major sign that this transformation is real.
It's what differentiates this whole bull run. The overall context is solid. You look at the full year, fiscal 2025, revenue came in at $42.1 billion?
Which is a decent 4.6% year-over-year rise.
Respectable, yeah. But honestly, nobody really cares about that overall number. The real story is the micro view.
The most recent quarter.
Exactly. Q1 fiscal 25, revenue hit $11.2 billion, and that surpassed what everyone was expecting.
And crucially, where is that revenue coming from?
It's highly concentrated, which is actually a good thing for visibility. That growth is almost entirely driven by their subscription services.
So cloud services and license support.
Yep. That now makes up 68% of total revenue. That recurring base, it's the reliable engine.
Okay, so let's talk about the specific engine that has investors so excited. The infrastructure piece, Oracle Cloud Infrastructure, or OCI.
Right.
That's where all the AI GPU demand lives, isn't it? What are the latest numbers showing us there?
OCI is the absolute star of the show. Revenue grew 31% year over year in Q1. That's up to $2.4 billion.
31% is a huge number.
It is. But here's the most critical detail you have to keep in mind. It's the acceleration.
Right.
That 31% growth, it moved up from 27% in the prior quarter.
Wow, so 4 percentage points of sequential acceleration. That's momentum.
It signals that enterprise customers are adopting their platform at a much faster clip, and it's heavily, heavily driven by the urgent need for AI infrastructure. They're grabbing that AI capacity demand.
Fascinating. So usually that kind of cloud growth means you have to just sacrifice margins to buy market share. But Oracle seems to be hitting scale while also expanding profitability. How are they pulling that off?
They're executing very efficiently. They're managing the legacy parts of the business really strategically. Operating margins expanded to 38.1% in fiscal 2024.
And that's a noticeable jump.
It is. The leverage comes from two places. First, managing costs in the older software divisions. And second, they're finally getting those economies of scale in OCI.
As it hits critical mass.
Exactly. And all this has led analysts to revise their earnings per share estimates upward. The consensus just moved from around $5.40 to $5.70.
That kind of upward revision in a short time is a powerful catalyst.
A much stronger catalyst than just looking at past performance, for sure.
Okay, so we're talking about the cost of growth. Building out this cloud infrastructure it's incredibly expensive, right? Buying GPUs, building data centers.
Massive CapEx.
So how is their cash flow holding up against all that spending?
Their cash flow generation is incredibly strong. And this is probably their biggest defense. They are a free cash flow machine. FCF in fiscal 2024 was $13.5 billion.
And that gives them a pretty healthy FCF margin.
A very healthy 13.4% margin. And this capital isn't just sitting around.
So what are they doing with that massive pile of cash? Is it all going back into the business?
No, and that's the interesting part. They're focused squarely on buybacks, which tells you management is confident that OCI is a strong enough organic growth engine on its own.
So they're returning it to shareholders.
Aggressively. In fiscal 2024, they executed $11 billion in share buybacks, a record for the company.
Which has a real impact on the share count.
It's reduced the share count by over 5% since fiscal 2022.
So that combination of high cash flow and aggressive buybacks makes their yield really compelling, doesn't it?
It really does. If you look at their FCF relative to their market cap, it sits at 8.4%.
Which is very high compared to their peers.
substantially exceeds the median in the S&P 500 software sector. It
Mm.
just means for their valuation, they're generating superior cash. It gives them this immense optionality.
Okay, fundamentals are solid, capital discipline is there, but here's the unavoidable question. Competition. I mean, AWS and Azure are they're orders of magnitude larger. What gives Oracle a real defensive edge, a moat against those giants?
This is where their legacy status, funny enough, becomes an advantage. It all comes down to switching costs. Deep, deep integration.
Your database dominance.
That's the key. Over 90% of the Fortune 500 still runs on Oracle databases. And these aren't minor workloads. This is their mission-critical transactional data. It's the heartbeat of the company.
So if you own the data, you own the customer, but why can't a company just move that data to AWS for a cheaper rate?
Because it is excruciatingly difficult and expensive. They use these proprietary engineered systems like Exadata.
Right, the hardware-software combo.
Exactly. It's optimized for their databases. And reports suggest it's 2 to 5 times faster for specific workloads than what you can get on a public cloud.
So it's not just about ease of migration into their own cloud, OCI, but the pain of moving anywhere else.
That's the moat. If a company wants to move their Oracle database to Azure, it often forces what's called re-architecture.
A complete rebuild.
You have to change the database structure, the code, the applications.
Yeah.
It's a years-long, risky, expensive project. Oracle lets you bypass all of that. They're the only major provider with a seamless migration path.
It almost makes OCI feel less like a choice and more like a necessary upgrade. That's powerful. And we have a stat on this, don't we?
We do, and it's one of the most compelling stats they've released. In fiscal 2024, 42% of their new cloud customers migrated from AWS to OCI.
From AWS.
From their largest competitor. That speaks volumes about the stickiness of their ecosystem.
And that advantage seems perfectly positioned for this AI boom, which is all about high-speed data access. What are they announcing on the product side?
They're tying it all together. They just announced an OCI AI-optimized Exadata, and the claims are bold.
How bold?
In their internal benchmarks, they claimed it was over 20 times faster than Azure ML for certain Gen AI inference tasks.
20 times faster. Okay, you have to take internal benchmarks with a grain of salt.
Of course. But even if it's half that, the performance advantage for an enterprise running AI on a core data is just immense.
So the market has to be reflecting some of this optimism, right? What are we seeing on the charts?
We are. The charts show that institutional conviction is growing. A critical event was the breakout above the 128 Tether level.
Which was a major resistance point.
For months, yeah. And once it broke through, that level flipped. So what was a ceiling is now acting as a strong support floor.
A foundational shift. Anything else on the technical side?
Yeah, back in January 2025, we saw a golden cross confirmation.
So the short-term moving average crossed above the long-term one.
Right. And traders often see that as a really robust long-term bullish signal. It suggests the recent buying pressure has real staying power.
But who is doing the buying? Is this just retail excitement, or are the heavy hitters, the institutions, getting involved?
This is overwhelmingly institutional accumulation. Total institutional ownership is now up to 78.6%. You're seeing the big asset managers, BlackRock, Vanguard, Fidelity, all significantly increasing their positions.
That lends a lot of credibility. But what about insiders? Are the people who know the company best buying in?
Yes, and that might be the most powerful signal of all. Insiders bought substantial amounts of stock in early 2025. We saw the CEO, Safra Catz, purchase 150,000 shares.
And the CFO.
The CFO, Christine Huguet, bought 50,000 shares. When top management increases their personal exposure after the stock has already started moving up, that signals real belief in the OCI transition.
It's a huge validation, but as we always say, every investment has risks. Let's talk about the bear case. Where could the story break down?
The primary risk is all about OCI margins. While the revenue growth is fantastic, its operating margin is still negative, around negative 11% in the last quarter.
That's the cost of war, right? They're pre-spending to capture all this future AI revenue.
Precisely. They're aggressively investing in GPUs, building out data centers. The risk is that if OCI growth slows down unexpectedly, that path to profitability could stall.
Which would surprise the market.
It would. The market is pricing in a pretty rapid transition to profitability for OCI.
Yeah.
Management has guided for that to happen in fiscal 2026.
And what's their structural defense for that margin pressure?
It goes back to their free cash flow. It's so strong. They still generate about $1.2 billion in excess cash, even after all their CapEx and dividends.
So they can fund the investment and still keep buying back stock.
Exactly. The Buybacks Act as a powerful defensive floor, which caps some of that downside risk if the margin story takes a little longer to play out.
Okay, what about macro risk? Corporate IT budgets. If the economy slows, do enterprises put the brakes on spending?
That's the second risk. Their legacy license sales, which are still about 20% of revenue, are definitely vulnerable in a slowdown. Those are often the first things to get cut.
But there's a mitigation there too?
There is. 87% of their total revenue is now recurring from cloud and subscriptions. That stable recurring base is so high that the downside from a macro slowdown is considered. Well, it's capped.
Okay, so let's look ahead. What are the key dates and events investors should be marking on their calendars? The near-term catalysts.
The biggest one is the Q2 earnings release on May 21st. Consensus is looking for about $11.4 billion in revenue and EPS of $1.49.
And the key thing to watch won't just be the headline numbers.
No, it'll be the forward guidance on OCI growth.
Huh?
Any beat there will be seen as more confirmation of the AI momentum.
And beyond the financials, where do they show off the next phase of their AI strategy?
That will be at Oracle Cloud World 2025 on June 4th. This is the big tech event. We're expecting them to launch something called the Oracle Cloud AI Fabric.
Which is, what, an LLM orchestration tool?
Basically, yeah, a unified tool to make deploying Gen AI simpler for enterprises. We're also expecting announcements about deeper integration with NVIDIA's new Blackwell chips.
And analysts will be watching for new customer wins there.
Big ones, yeah. Any new Fortune 100 companies committing to OCI would be huge news.
Finally, what about rumors? Any market chatter that's adding to the narrative, even if it's unconfirmed?
There's definitely noise, and we have to stress these are just rumors. The first is about a potential large-scale government contract. There's chatter about a billion-dollar-plus Department of Defense Cloud One contract.
And the second rumor?
Speculation that they might try to acquire a U.S. semiconductor design firm.
To build their own in-house AI chips, like Google?
Exactly, to build accelerators tailored for their own environment. It's speculative, but it adds fuel to this idea that Oracle is getting very serious about being vertically integrated for the AI era. So, to summarize the Oracle story, you have this foundational database moat, which creates these powerful switching costs. That's now combined with accelerating AI-driven cloud growth. It's a unique advantage that competitors really struggle to match. The financials, the capital return, the technicals, they're all signaling strong momentum into the second half of the year.
A compelling case for sure. It's clear the market sees this as more than just a slow turnaround story. It's an accelerating capture of mission-critical AI infrastructure demand. If you found this analysis useful, remember to subscribe to Smart Wealth with Joshua for daily insights that keep you ahead of the market.